Three, two, one, zero. Ignition. Liftoff.
Hi, this is Yuri, and you're watching Moontower HQ.
Hi, everyone. My name is Nick, and this week we'll be talking about retail traders in Bitcoin. Really, to begin, of course, let's define retail versus institutional. So retail would be probably the average individual, and the institutional would be something more like a corporation that would be involved in the buying and selling of Bitcoin in this particular case. I think the biggest distinction between the two is, of course, volume size and basically level of sophistication. When you're talking about institutional players, really you're dealing with very large sums, and they're conducting their operations primarily through OTC desks or through dark pools or other types of means. Whereas retail individuals, they often tend to use platforms that are a little bit more accessible, which require slightly minimal amounts of effort to get onboarded with. So you have Kraken as being an example of something like that. I think one of the other important aspects to understand is when people first get started with Bitcoin, they really see trading as an easy way to make money because, as people know, the Bitcoin market is relatively volatile. The volatility has been granted decreasing over the past couple of years, but it's still way more than the traditional space. I mean, 1% move in the NASDAQ or the FTSE is something to really pay attention to, while with Bitcoin, you get 1% moves on the daily. So you're really looking at a much more highly volatile market in that regard. And for that, there seems to be a lot of opportunity on the onset. But when the retail individual enters this space, and I myself was like this similarly as well, I thought, hey, why not? I could just go and really quickly put in an order, and then maybe I'll be able to make 2 or 3 or sometimes 1% a day. Well, I think I was quickly turned to the reality of the situation, and that it's not that simple, because you are also paying a certain amount of costs for entering into the trade and exiting to the trade, commissions. That actually eats away at your profit if you're entering and exiting on the short term. And then especially when you get into leverage instruments, such as futures markets, that's when you really can get kind of over your head. But really, at the end of the day, I think it's important to understand the concept of trading versus investing in the first place. And trading is something when you're actively involved in the market. Investing is when you're looking actually for the long term. Yuri, in your opinion, when you're seeing kind of what are the trends, I guess, maybe I should ask, that you're seeing in the current environment when it comes to retail individuals in the market?
Yeah, thanks for the question. I think the current trend is focused more on retail adoption in terms of dollar cost averaging methodologies, because that's what we've been seeing for the past several months on the market. And companies all over the world have appeared that provide such a service. I think this is really needed because a lot of the retail investors, they do not really want to time the market or to learn the dynamics of trading, to learn different types of orders that are present on exchanges, such as market order, limit order, not to speak about all the other kinds of advanced orders. All they want is some exposure to Bitcoin. And some of the people, they don't have even traditional trading accounts that are connected to legacy financial instruments, for example, TD or Fidelity. So they're not able even to buy exposure in funds like GBTC by Grayscale, where essentially you're trading not really Bitcoin, but an IOU for Bitcoin, and you're able to exit the same way. But again, we're also dealing with issues like a minimum 6 months lock-in period, which for some people may not be the best deal out there. At the same time, the biggest issue that I personally have with such funds is that you do not hold the private keys to the Bitcoin that you buy. So, and this kind of defeats the purpose of Bitcoin, because Bitcoin is about self-sovereignty, and self-sovereignty can be only achieved if you hold the private keys to your stash. Now, when you buy with a dollar cost averaging application, the Bitcoins usually, from what I've seen with companies out there, Bitcoins go directly to your wallet. or they provide a wallet for you and the functionality to withdraw Bitcoins directly to your wallet. So you are able to self-store, self-custody your Bitcoins, which I think is a great advantage. So essentially, these days, the trend is that you can set up your cycle or uh, set up a way of purchasing Bitcoin, say once a week or once a month for a specific amount, and simply forget about it, just knowing that your stash is growing automatically. So this is the main trend that I see in the retail space these days. Of course, there are other retail applications being developed, and recently we've seen some payments applications developed, such as Lightning Strike, which is a great way of combining the Bitcoin world and the legacy world, because essentially people who want to pay a Bitcoin invoice now don't have to start a Bitcoin wallet. They don't have to start a node to worry about the seed and the keys or anything like that. They can pay a Bitcoin invoice from their bank account directly and instantly. This is only in the US right now, but this is great in terms of payments. So for investors, I think uh, the main points of entry remain the same. Those are either brokerage firms, Bitcoin ATMs, or dollar cost averaging applications.
Yeah, and I really find that a lot of the people that are actually adopting these kind of technologies are individuals that have already been very familiar with online payments. So you mentioned Stripe, for example, as being a really good merger of the two spaces and the two ecosystems, that being Bitcoin and of course the traditional environment. And if you look at the user base, statistically speaking, you have a lot of the younger generation, and people of our age as well are included, you know, dub them the millennial or whatever, if you will. But the point being is that these individuals grew up with an affinity and an accustomed, I guess, understanding of payments and digital payments in general. And they also have a certain level of comfort that has been ingrained into them. And I feel that really this is one of the biggest keys to this generation adopting Bitcoin in general, is that assurity that something in the digital space actually holds value in the real world and is rationally, in a certain way, tangible. Even though you can't physically touch it, the younger generation seems to firmly believe that something is there. Where you're looking at generations past who have not grown up with the internet by their side, mobile technology, especially mobile payments, they're a little bit more hesitant to adopt Bitcoin because they, I feel personally, don't quite understand intrinsically that something digital can still hold value. They have and place a certain amount of stature on being able to physically touch something, which is why I believe they're more trending towards adopting things like gold. So if you're looking at it again from a trends perspective, I really feel that Bitcoin is taking off among this younger demographic, but because of the ideological basis for Bitcoin in general and the concept of sound money, that is inescapable. And there's actually been a lot of currently information floating around that the baby boomer generation is actually starting to get interested in this as well, and they're starting to diversify. And I really, this all comes down to having a long time preference for value. So Yuri, in that sense, actually, could you help us understand a little bit about what a long time preference means and what short time preference means when it is talking about Bitcoin and digital assets?
Yes, of course. Well, time preference is an economic term that was recently popularized by Saifedean Ammous in the Bitcoin circles, but it was also discussed by other economists, mostly coming from the Austrian economics background. And essentially it talks about the value that you place on certain goods, and how fast you're willing to forego these goods in order to essentially enjoy them. So you could enjoy something right now with and get the kick out of it, so to speak, or you could postpone consumption to a later date and potentially see an increase in such a good. For example, savings is a low time preference activity because you are postponing instant gratification, instant consumption for to a later date. which means that you're accumulating wealth and you're saving. For example, when you're dollar cost averaging Bitcoin, essentially you're postponing, you're foregoing any consumption that you could with those amounts of money. Instead of buying a 6-pack of beer, you put that amount of money into some Satoshis, and a year later you have a stash of Bitcoin. And with Bitcoin's potential rise, as it happened before historically, uh, obviously you can see a rise in the value of your Bitcoin portfolio. So this is essentially the ultimate marshmallow test, the marshmallow test from the famous experiment in psychology, where you give a kid one marshmallow that he can eat now, or two marshmallows if he can only wait for 15 minutes. And it was interesting how kids reacted to this experiment. Some of them obviously ate it right now because it was so difficult to resist. Others were patient enough. And the study proved, of course, that the ones that were patient enough, they became a lot more successful in the future as adults. So this is what low time preference is about. And high time preference is all about immediate gratification, immediate consumption. And unfortunately, these days, the whole economy is built upon high time preference. The whole financial system is actually a high time preference financial system that we have. It encourages consumption and it discourages savings. So that's what people have to keep in mind. But the crux of the matter is that the money that people use actually affects people's behavior. So if you have a sound money that you think will potentially grow in value and will keep growing in value over a long term, your behavior suddenly changes and you start foregoing certain things in order to save more of that money. But if you know that your money will devalue every single year, and in cases of hyperinflation, your money will devalue dramatically, like what is happening in Lebanon right now, where the currency lost half of its value already, you simply cannot afford to save. You have to spend the money before it loses value. And this type of monetary system incentivizes high type preference behavior and more consumption, and even indebts people who would otherwise not take any debts. That's the main description of it. I hope it helps.
Yeah, absolutely. You know what? And I could have said it better myself. I think that's actually a really good place to wrap up our quick discussion today. So thanks everyone for joining us, and we hope to see you next time. My name is Nick, signing out.
And my name is Yuri. Check out moontower.co.